So welcome to this presentation on examples of ratios in use. We're going to take an example, show the ratios, calculate them, see them over in a trend analysis and a peer analysis comparison. So here's the balance sheet we're looking at. So Sequoia Bonsai's balance sheet as at December 31st, 2020. We have cash and cash equivalents, accounts receivable, inventories, prepaid expenses. Those are the current assets, fixed assets at cost, minus accumulated depreciation, investments long term, and so we have our total assets. So, sheet, the liabilities side. So accounts payable, notes payable, accrued liabilities. Then we have shareholders' equity, additional paid-in capital, retained earnings. So that gives us a total equity. The income statement, we have revenues, cost of goods sold. That gives us our gross profit. Then we have sales, general and administrative expenses, operating income or earnings before interest and tax, then interest expense, earnings before tax, then the tax, and then we have our net income. The net income is split into two, the cash dividends and the amount of earnings that are returned. So that's the additions to retained earnings that we'll see on the balance sheet. Now, current ratio shows the firm's ability to cover its current liabilities with its current assets. And for Sequoia Bonsai, we had the current assets of $111.95 and current liabilities of $500, so 2.39. So that's a generally good number, which means we have more than double the amount of current assets. Now you can compare this over time. First of all, the company itself here and the industry, so it's comparable. And what this shows is that the ratio is stronger than the industry average. So the trend both for the company and the industry is also strengthening, as we can see, going up. The quick ratio, also called the asset test, shows a firm's ability to cover current liabilities with the most liquid assets. So what we do is we do not include inventory, we do not include prepayments in this case. So in the case of Sequoia Bonsai, we have 0.97. So it has enough cash and equivalents as well as accounts receivable to cover the. So here we see the trend, and now you see something different. The ratio is weaker than the industry average, and as well it's getting worse over the last couple of years. So that is an indication here that maybe we have too many inventory, too large an inventory, particularly since the current ratio was good, but the quick ratio is showing some weakness. So a strong current ratio and a quick ratio indicates potential problems with the inventories account, and the industry has a relatively high level of inventories, as you can see, because the industry has 100% of the current liabilities are equal to the inventory. But in the case of Sequoia Bonsai, we're even higher in this case. This shows the trend as a graph, and you can see how it is significantly increased with the current ratio. And here you see how it has changed with the quick or asset test ratio. So the current ratio has been rising, the quick ratio has been declining. So that is an indication here that in the same time with the industry, the current ratio has been rising slowly, and the quick ratio or asset test ratio is relatively stable. So inventories are a significant problem. It's a bit of a problem perhaps in the industry, but it's a bigger problem with Sequoia Bonsai. Now debt to equity is showing a little bit the financing of how much of the financing is by debt as compared to financing by equity. So here we have the total debt, again that's liabilities, over equity of basically 0.9. So as you see, as I mentioned already, liabilities are considered as debt, Some analysts will use only interest-bearing debt, but that would be specified and should be specified. And depending on the industry, debt equity ratios do vary widely. So as you see, we need to compare with the industry. Here we have the industry averages, and as you can see, the utilization of debt is about equivalent to the industry. Now, debt to total assets. This is again similar to the measure of debt is the same, but instead of using equity as a denominator, we're going to use total assets. As you can imagine, these ratios are related. The income statement, you have revenues, cost of goods sold, that gives us our gross profit, and we have sales, general and administrative expenses, operating income or earnings before interest and tax, then interest expense, earnings before tax. Now we move to equity multiplier as a measure of leverage. It indicates how the company uses debt to finance assets. So it's a measure of leverage using, and it also has a relationship between our return on assets and return on equity, which we will see in the Dupont identity. So for Sequoia Bonsai, the values are its total assets over total equity, and that gives us a value of 1.91. And as you can see, that is also very similar to the industry. So it's very much in line. So now we have times interest earned, also called interest coverage ratio. It shows to what extent the company can cover the interest charges. We calculate it as earnings before interest and tax divided by interest expense. EBIT is the line item just above interest expense. So of course, a figure of 1 would be critical for the firm. That would mean that EBIT minus interest expense would equal 0, and that's the earnings before tax. So often also in financing agreements, there would be minimum values that would have to be maintained by the companies when they take on financing. Now you can compare this over time. First of all, the company itself here, and the industry, so it's comparable. And what this shows is that the ratio is stronger than the industry average. So the trend both for the company and the industry is also strengthening, as we can see, going up. Here you see it as graphically, and of course this is a ratio that we would like to see higher numbers, so it's obviously not a good sign. So summarizing the coverage trend analysis, the interest coverage ratio for Sequoia Bonsai has been falling since 2018. Over the past couple of years, it has been below industry averages. Now this indicates lower earnings before interest and tax may be a potential problem, because we also know that the debt levels are in line with the industry average. So that means the source of the problem is not the level of debt, it would be the level of earnings. Now we're moving on to activity ratios, also called efficiency ratios. So we have receivables turnover. This indicates the quality of receivables and how successful the firm is in collecting them. For Sequoia Bonsai, the turnover is calculated as credit sales over accounts receivable. That gives us 5.61. So it returns over the receivables more than 5 times a year. Turning that receivables value into days receivables, that tells us about, on average, how many days the receivables are outstanding, how many days the company has to wait before receiving payment for those receivables. We just calculate the days in the year divided by whatever the turnover is. Here we have receivables turnover. So we have 65 days in this case. So that means on average, the company collects its receivables in 65 days. Now when you look at that trend over time, Sequoia Bonsai is now in line with the average collection period and matches the industry, and has actually improved its numbers since 2018. So welcome to this presentation on examples of ratios in use. We're going to take an example, show the ratios, calculate them, see them over in a trend analysis and a peer analysis comparison. as you can see now, the comparison with the industry, you see that they're quite subpar compared to the rest of the industry. So they're much slower than the rest of the industry. Here you see the trends. In the industry has a reduced value for the inventory turnover, and Sequoia Bonsai has been much below the industry rate and is still falling. Those are not good signs. That's not good for the industry, but it's much worse even for Sequoia Bonsai. Accounts payable turnover, that indicates how promptly the company pays its suppliers. Now, payables turnover is calculated as purchases on credit over accounts payable. Now, purchases on credit sometimes is not easy to calculate. It requires us to understand or to see how much the relation is between the changes in the goods inventories as well as the cost of goods sold. That's again dealt with in another place. Otherwise, we often use the cost of goods sold as a proxy for the purchases. That's not exactly the same, but that's about that. But it's generally very similar in size. So here we have a value of 16.5. That means they turn their payables over relatively quickly, more than once a month, clearly, more than 12 times a year. And the days payables is the way of calculating how many days on average they take. Again, here we're going to take 365 and divide it by the payables turnover. That gives us 22.1 days. So that's the average time that Sequoia Bonsai takes to make its payments, which is generally fairly quick. It depends again on typical industry averages. And here you see, so Sequoia Bonsai has improved its days payable. So is this a good value or not? If you compare it to the industry, which is mostly stable at the 2018 values. Well, it depends, of course. It may reflect supplier discounts for prompt payment. So if you make a quicker payment, you pay less than the 100% of the price. Well, that's a benefit. But it also may be reflecting of the fact that suppliers might demand prompt payment due to financial weaknesses. So suppliers are not comfortable essentially lending money to Sequoia Bonsai. So the suppliers say we want prompt payment, or maybe even for some parts of their business, cash upon purchase. That might be also the cause here. Sheet, the liability side. So the accounts payable, notes payable, accrued liabilities. Then we have shareholders' equity, additional paid-in capital, retained earnings. So that gives us a total equity. Now the gross profit margin, we're moving on into profitability. That indicates the efficiency of operations and the capacity of the company to price in a profitable way. So that's the gross profit divided by net sales. So we have here 27.7%. Again, we have to compare it to the industry. And you can see here that the industry has been strengthening, whereas Sequoia Bonsai has been weakening. So this is actually quite a bad sign and an indication that they may be having a problem with both efficiency or the productivity or the product placement. There may be some things to analyze in more detail here. Here you see the trend, and as you can see the trend, we would like to see the profit margins to be high or growing, and you can see where Sequoia Bonsai is going in the opposite direction of the industry. Now the return on sales or net profit margin or profit margin, it tells us how much profitability the company has after taking account all expenses and income taxes. So it's just the net income over the sales. Revenues, so here we have 4.1%. Again, this is something that changes or is non-standard. It depends on the industry that we're talking about. So some industries are very high margins, some industries are relatively or very low margins. And those ones with lower margins tend to have higher turnover figures, so they turn things over a lot, and those with higher margins tend to turn things over a bit slower. But now when we compare, first of all, the trend from 2018, and you look at the industry as well, you see where things are going in the opposite direction, and in a worrisome direction for Sequoia Bonsai. So Sequoia Bonsai has a poor and a falling return on sales. Here you see it particularly graphically. And again, these are figures that we'd like to see to be high, stable, or growing. Again, we have to compare it to the industry, and you can see here that the industry has been strengthening, whereas Sequoia Bonsai has been weakening. So this is actually quite a bad sign and an indication that they may be having a problem with both efficiency or the productivity or the product placement. And there you see, again, it's going in the wrong direction. The industry is also having a bit of trouble. It's rebounded since 2019, but it's definitely poor as compared to the industry, and it has been falling over the past 2 years. Here you see it again graphically. This is again a number that we'd like to see high and stable or growing. But now when we compare, first of all, the trend from 2018, and you look at the industry as well, you see where things are going in the opposite direction, and in a worrisome direction for Sequoia Bonsai. So Sequoia Bonsai has a poor and a falling return on sales. And here we see it confirmed with the industry average and the trend analysis. It's gone from 16.6 down to just under 8%, whereas the industry has also gone down, but nowhere near as much, and it's quite a bit higher. So that there we see it's also underperforming. Now we see this graphically again. Similar analysis. You can see quite visually how Sequoia Bonsai is significantly below the market and the industry. Now the Dupont analysis is calculating the return on equity, which is net income over average equity, and breaking it down. So we'll look at the gray blob. We have net income over total assets. We multiply that by total assets over equity. That gives us the net income over average equity. And then we can analyze that further, and we see that that's net income divided by revenues times revenues over assets times assets over equity. Well, these are three ratios that we use. That's return on sales, total asset turnover, and equity multiplier. Then so we can see what the source of the low return on equity would be. And as you can see, the earnings power from the return on assets shows how much it's dependent on the sales margin and the asset efficiency. So the sales margin, the profit margin or return on sales, which we calculated was 4.1, and the asset efficiency or the total asset turnover was 1.02. So that gives us our total return. And the return on assets in the industry is 8.2 times 1.17. So you can see that the asset efficiency is somewhat lower, and the sales margins, so the profit margins, are significantly, they're 1/2, and that's where we get a large difference between our company and the industry. Now the return on equity tells us about how the investor, the equity holder, will gain his profitability or her profitability. And the return on equity is simply the return on assets times the equity multiplier. So for our company, we have 7.9. Our multiplier is 1.9. And for the industry, the multiplier is 1.88. So here, the difference is basically sourced because of our lack of return on the assets. The multiplier is about industry average, and of course, if the multiplier is very high, that's an indication of risk as well, because it shows that our company would have a lot of debt. So we're in line here with the industry, but our problem is the profitability in the first place. So the profitability ratios have been all falling since 2018. Each has been below the industry averages. So the cost of goods and administrative costs may be both too high and a potential problem for Sequoia Bonsai. So these are things to be looking at as a next step from the company internally. Now the result is consistent with low interest coverage ratio. Inventories are clearly too high. They're much higher than industry average, which already is quite high. And they may be paying off creditors a bit too soon. That may also be forced by the creditors. It may not be, but there is maybe a source of potential gain by negotiating better terms. Cost of goods sold may be too high. Selling general administrative costs may also be too high. So hopefully that helped, and thank you for your attention.